Investing in real estate is one of the very best ways that you can grow your wealth. And in this video, we are going to discuss with you how we approach buying real estate as value investors. And we're going to share with you 3 things that we wish somebody had taught us before we bought our first investment property. So let's dive in. Hi everyone, I'm Sam.
And I'm Chris.
Thanks for tuning into our channel where we explore achieving wealth and financial freedom through a 3-part strategy.
Earn more, spend less, and invest the rest. Thus far, in the videos in our channel, we've been talking about value investing principles, money habits, and investing in the stock market. But investing in stocks isn't the only way we have to grow our wealth. We've been investing in real estate for several years, and it has served us very well.
That is why we are super excited to be sharing this video with you to kick off our real estate investing playlist. We hope that you find our insights valuable, especially if you are just getting started with your own real estate investing journey. Now, we are also working to grow our channel, so if you like this video, please hit that subscribe button.
All right, so let's kick things off. Just like investing in the stock market, there's several different strategies that you can use when it comes to investing in real estate. But personally, we like to buy rental properties that produce a monthly income. That's because at the point we are currently in our financial freedom journey, we like to have productive assets that produce cash flow month in and month out. With all of our investments, we ask ourselves 4 different questions. Do we understand the investment? Does the investment have competitive advantages? Does the investment have a good and capable management team? And can we buy the investment at a discount to fair value? So let's jump into question number 1. Do we understand the investment?
Now, with rental properties, this is a lot easier to determine as opposed to investing in stocks of companies, because it's pretty simple to understand housing and properties. Everybody needs a place to live, and that's not going to change anytime soon. So you get it. You live in a house or an apartment. Other people live in a house or an apartment. So it's pretty easy to understand how the housing market works. On to question number 2. Does the investment have a competitive advantage?
Yeah, so what we're looking for is good schools, good employment opportunities. So lots of employment, lots of diversified employment. We don't want employment to be centered around one big factory that if it closed, you no longer have a job market in the area. We're looking for things that limit the amount of new development that we'll see. So these might be physical barriers like a national park or mountains or something like that that's actually keeping the supply low and the demand high. So we always want to know that in the future, this property will have tenants that want to rent it and want to live there. All right, so let's move on to question number 3. Does the investment have a capable and honest management team?
All right, so this is a little different when we compare this to stocks. And the main reason is because with real estate, you get to pick who is managing your property. If you decide that you want to manage it yourself, that's fine, but you just have to make sure that you have the time and the capability to manage it effectively. Now, if you're like us and you want to hire a professional property manager to manage your property for you, then you have to ask yourself the same questions. Are they capable? Are they willing to do the work that is necessary? Okay, that brings us to question number 4. Can we buy it at a discount to fair value?
Okay, because rental properties produce a monthly income, we can put a value on it. So to do this, we required understanding the cost behind owning and operating this as a rental property. So this includes the mortgage, this includes insurances, this includes taxes, this includes the yard upkeep. It also includes a lot of non-cash expenses. So this includes vacancy, maintenance, capital expenditures, those things that happen in the course of owning this property that you're going to have to spend money on. So this is a new roof every 10 years or a new air conditioning unit. So I just want to emphasize the non-cash expenses are something really important that you need to account for. And it's something that we see people often leave out when they're looking at the actual numbers of a rental property. And it is a huge mistake if you leave these out. So make sure you account for these things. Vacancy, CapEx, maintenance and repairs, they are huge to your success as owning a rental property. All right, so jumping back to the valuation of the property, rent minus all the expenses gives you a net operating income. This is the money that's left over after you pay all the bills. And this is going to allow you to put a value on what the property is by just figuring out what kind of return you're looking for over time.
One of the amazing things about rental properties is that they have 4 different ways of generating wealth.
Yeah, so the first of these is cash flow. This is just rent minus all your expenses and the cash that's left over from that at the end of every month.
Second is appreciation. Now, typically, when you hold a real estate property over time, it will appreciate. And essentially, this is just an increase in the property's value during the time that you own it.
Yeah, and if you buy the property on a mortgage, you're able to leverage your return. So just as an example, let's say that you put 25% down on a property, and over the period that you own it, the property price increases by 25%. Then you would actually have 100% return on the cash that you put into the property.
Third is debt paydown.
Yeah, so this is the equity that you're building in that property every month as your tenants pay down your mortgage. So if you go back to the example of a property where you put 25% down on, and let's say it's a 30-year mortgage, then at the end of that 30 years, you've quadrupled your money because originally you owned 25% of the building, now you own 100% of the building. And this is if there's zero appreciation in the property. So it's an amazing way to gain a return on your property.
Fourth is tax benefits. So typically you are taxed less on the income you make from an investment than you would be on the income you make from your 9 to 5. There are also lots of incentives for property ownership, things like deferments and other benefits that you can use to your advantage to help you lower your tax bill.
Yeah, so the sum of these 4 wealth generators equals the total return on your property.
All right, so now on to the question you've probably been waiting for. How do we value our rental properties?
So we value our rental properties based on a cash-on-cash return. So this is all the cash that the rental property produces or that's left over after we pay all the bills, divided by all the cash that we put into the rental property. So this is the down payment, this is the closing costs, these are any rehab costs that we might have to put in to get the property up to a standard that we could actually rent it out.
That's right, and for us, we're looking for a return of 12% in order for us to consider investing in a rental property. And for us, all of the other benefits that we talked about before, the appreciation, the debt pay down, and the tax benefits, they're all just icing on the cake.
Yeah, and this approach really protects us from a downturn in the real estate market because we don't really care what the market is pricing our property at after we own it. We're happy to collect a 12% return on our money every year and own it for as long as it takes. And eventually the market will price it in a way that we are happy with, and eventually it'll offer us a price that we can't refuse. And at that point, we may consider selling it. But in the long term, we're happy to just sit there and collect the rent.
All right, we're at the end of this video, and we want to summarize by sharing with you those 3 key lessons that we wish we had learned before we bought our first rental property. Lesson number 1 is that your property manager is essential to your success. They will make or break you. They're going to be the reason why you either make or lose money on your property. So it's really important that your property manager is capable, that they are proactive, and that they are aligned with your best interest. Lesson number 2 is that when you are evaluating your property, there are going to be expenses that you did not account for. So make sure that you always give yourself a little bit of cushion. And lesson number 3, you cannot be successful in real estate without a great team by your side. In our experience, the key team members that you need to have are an excellent property manager, an amazing handyman that you can trust, a mortgage broker, a real estate agent, and a lawyer.
All right, so owning a rental property is a great way to get your money working for you. And in future videos, we will go over the complete process of how we value a rental property, as well as go over a lot of other great topics related to owning and operating rental properties.
All right, guys, thank you so much for watching this video. We're really happy that you tuned in. If you found it useful, let us know by hitting that like button, or better yet, subscribe to our channel. Remember, earn more, spend less, and invest the rest, and we'll see you next time.